Greg Daco is with us. He is Oxford Economics Chief U.S. Economist. And Greg, economic growth is going to peak and then decline. This is something that we've all been talking about, right? And so when you look at sort of what the market appears to be going through right now, particularly on the bond side, not as much on the equity side, because as Brian rightly points out, we were just at records. What do you think is sort of working its way through here?
I think there are a variety of factors that are affecting both bond market and equity markets. As you correctly pointed out, we've gone from a spring bloom to a summer boom, but this is likely peak growth. And as we pass peak growth, I think markets are having to readjust to an environment in which we're no longer going to see an acceleration in growth, but actually somewhat of a cooling in the pace of growth. The economy remains quite firm. We're still seeing strong momentum in terms of consumer spending trends, in terms of business investment trends. So there is still that strong summer momentum, but we're no longer going to see accelerating momentum. And I think that's key to keep in mind. The other thing to keep in mind is that we're in an environment where, although the health situation has improved quite dramatically, we're seeing the emergence of this Delta variant that's becoming the most pervasive form of coronavirus, and that is leading to some potential downside risk or increased downside risks in terms of the United States, the rest of the world, and especially the places that have the lowest vaccination rates.
Well, to that point, Greg, are we smack in the middle right now? Are we in a growth scare?
Well, I think right now what we're seeing is that we're in an environment of very strong growth, very strong momentum, but one in which we're no longer going to see that acceleration in growth. So we're near peak growth. We're also likely near peak inflation, which is also a theme that has been key over the past few weeks. So as we see growth momentum gradually cooling in the second half of the year, as we see inflation also likely to cool in the back half of 2021, we're going to be in this strange environment where the economy is still rebounding from a very deep crisis with an unusual mix of very strong demand, supply that's slowly coming back online, but an environment in which we're no longer accelerating. And so I think that will take some time for markets to readjust to. And at the same time, we have this tremendous uncertainty as to what the Fed is going to do in terms of monetary policy.
Yeah, and Greg, let's talk a little bit more about those inflation dynamics and just, what the main components have been driving inflation and where we see that going, going forward. I mean, you look at used auto prices just hitting the tape the last few minutes. They were down 1% last month. So the absolute level of used car prices is still extremely high relative to a year ago, but the rate of change has slowed down. And so does it seem, in your view, likely that across the range of the major goods and services areas that have seen the pricing pressure, similar dynamics will start playing out?
Yes, what we're observing right now is a great rotation in terms of spending, in terms of inflation, in terms of the broad economic dynamics across the U.S. economy. On the inflation front, we had very strong goods price inflation. Goods prices were rising very rapidly. And as you noted, used car prices were one of the categories that were seeing the most significant increases on a month-to-month basis, and therefore the largest inflationary numbers. That's going to turn around. That's going to be an environment for the rest of the year where we're going to see cooling prices and therefore cooling inflation dynamics on the goods front. Meanwhile, we're still going to see some stickiness on the service sector front, where inflation on the service side is actually going to pick up. And so we're going to see this rotation in the inflationary dynamics, but on net, we're going to see inflationary dynamics rather cool towards the back end of 2021 and into 2022. So we're going to be in this very unusual environment where the economy remains very strong, but supply is responding to that demand, and we're going to see some alleviation of some of these inflationary pressures, which will make for a very interesting environment in early 2022, where inflation may be lower, the economy still growing at a strong pace, and big questions as to what the Fed is going to do with its asset purchases and with its rate policy.
Well, but Greg, the picture you paint doesn't really make for a lot of suspense from the Fed, right? That they should just keep doing what they're doing. I mean, if you're going to have this backdrop like you're describing with not much inflation, relatively strong growth, why should they do anything?
Well, that's our view. That's our forecast, and that's if our forecast is realized. But as you know, there are differing views. There are views, and not so long ago, there were a lot of people talking about runaway inflation, the risk of runaway inflation, the risk of an environment in which inflation would essentially force the Fed to react earlier. That's never been our view. We've still been of the view that essentially the Fed would provide some signals that it intends to taper its asset purchases around the start of 2022, and that it would raise rates twice in 2023, but only starting in 2023. So still some time before we see some tightening of monetary policy. One of the interesting facets that we saw yesterday in the FOMC minutes was that there are really two camps, even within the Fed. Those that are still wedged to this idea of a flexible average inflation targeting framework based on outcomes, and those that are based on expectations of outcomes. And I think the core is still towards the dovish side, based on the outcome of economic data. But we're seeing a growing faction that is increasingly hawkish and desirant of tightening monetary policy a little bit earlier.
Well, Greg, what's the potential market and economic impact if the Fed does, in fact, do an early taper?
Well, I think it would be quite a negative reaction. I mean, right now we have a situation in which financial conditions are very loose. We have seen even a loosening of financial conditions given the recent fallback in yields. So an environment in which the Fed would actually surprise markets and indicate an earlier tapering and perhaps give signs of an earlier tightening of monetary policy via rate hikes, that would, I think, cause disruptions in financial markets, lead to a tightening of financial conditions, rising yields, perhaps a taper tantrum, and a negative environment for equity. So I don't think that's necessarily what the Fed wants to do. Right now, the Fed is probably very happy with how financial conditions have loosened, despite an early signal, an early pivot towards a slightly more bullish and less dovish stance at its last FOMC meeting.
And Greg, how big, you mentioned this earlier, but how big of a growth impediment is the new COVID Delta variant?
We don't know, is the truth. We know that there is a rise in the number of Delta cases, and we know that increasingly it's the majority of the cases are Delta variant cases. So we know that that is a key concern. In the U.S., we know that there are some counties where vaccination rates are still very low. We're talking 25, 30% in some of the lowest vaccination rate states. Meanwhile, some other states have high vaccination rates, which is quite encouraging. The key question really is going to be how authorities react to a rise in the number of cases. We can take the UK as an example, where we're now seeing a very rapid increase in the number of Delta variant cases, and authorities are debating whether to reopen the economy as expected in the middle of this month or whether to delay that. So it really depends on how authorities react, because that will be the key factor that determines the economic impact of this new spread of Delta variants.
Yeah, and here in the U.S., of course, the genie's already out of the bottle, so that could be an even more challenging question for those areas that are not very vaccinated. Greg, thanks so much. Good to see you this morning.
You.
Greg Daco, Oxford Economics Chief U.S. Economist.